I was staring at a statement from my financial advisor, and the fees they were charging me were staggering $2,150 in the past year alone, for a portfolio that wasn't even beating the market. That's when it hit me, I was paying for advice that wasn't even working. You're probably in a similar situation, feeling like you're throwing money at a financial advisor without seeing any real results. You're not alone. Millions of people are in the same boat, trying to make sense of their finances and get ahead, but feeling like they're being held back by costly advice. By the end of this video, you'll know exactly how to take control of your finances and make informed decisions without relying on a financial advisor. You'll learn how to create a personalized investment strategy, how to optimize your budget, and how to avoid costly fees that can eat into your savings. I know a thing or two about this because I've been in your shoes. I used to work with a financial advisor, but I realized that I was paying way too much for their services. So, I decided to take matters into my own hands and start learning about personal finance. It wasn't easy, but it was worth it. I paid off $27,419 in debt on a $51,340 salary, and I didn't need a financial advisor to do it. The first step I took was to educate myself on the basics of investing. I learned about index funds, ETFs, and other low-cost investment options. I also learned about the importance of diversification and how to create a balanced portfolio. It's not rocket science, but it does require some effort and dedication. One of the biggest mistakes people make when it comes to investing is putting all their eggs in one basket. They might invest in a single stock or a single type of asset, and then wonder why their portfolio isn't performing well. The key is to diversify, diversify, diversify. By spreading your investments across different asset classes, you can reduce your risk and increase your potential for long-term growth. For example, let's say you have $10,000 to invest. Instead of putting it all into a single stock, you could put $3,000 into a domestic stock fund, $2,000 into an international stock fund, $2,000 into a bond fund, and $3,000 into a money market fund. This way, you're spreading your risk and increasing your potential for returns. Another important thing to consider is fees. Financial advisors often charge high fees for their services, and these fees can eat into your savings over time. For example, let's say you have a $100,000 portfolio and your financial advisor is charging you a 1% management fee. That's $1,000 per year, just for the privilege of having someone manage your money. By contrast, a low-cost index fund might charge a fee of just 0.05%. That's $50 per year, a huge difference. So, how can you start taking control of your finances and making informed decisions without relying on a financial advisor? The first step is to educate yourself on the basics of personal finance. There are many great resources available online, including books, articles, and videos. You can also consider taking a course or working with a financial planner who charges a flat fee instead of a percentage of your assets. The next step is to create a budget and start tracking your expenses. This will help you understand where your money is going and identify areas where you can cut back. You can use a budgeting app or spreadsheet to make it easier. For example, let's say you make $4,000 per month and you want to save 20% of your income. That's $800 per month. You can set up a budget that allocates 50% of your income towards necessary expenses like rent and utilities, 30% towards discretionary spending, and 20% towards savings. Once you have a budget in place, you can start thinking about investing. This is where things can get a little more complicated, but it's still manageable if you're willing to put in the time and effort. You can start by learning about different types of investments, such as stocks, bonds, and mutual funds. You can also consider working with a robo-advisor, which can provide you with a low-cost, automated investment plan. One of the biggest advantages of a robo-advisor is that it can help you avoid emotional decision-making. When you're investing on your own, it's easy to get caught up in the emotions of the market. You might feel like selling your stocks when the market is down, or buying more when the market is up. But this can be a recipe for disaster. A robo-advisor can help you stick to your investment plan and avoid making impulsive decisions. For example, let's say you have a $10,000 portfolio and the market is down 10%. You might feel like selling your stocks and putting your money in a safe asset like a money market fund. But if you have a long-term investment plan, it's probably better to stick with it and ride out the market fluctuations. A robo-advisor can help you do this by automatically rebalancing your portfolio and keeping you on track. So, what's the next step? If you're ready to take control of your finances and start making informed decisions without relying on a financial advisor, I want to hear from you. Drop your biggest financial challenge in the comments below, and I'll do my best to help. And if you found this video helpful, be sure to hit the like button and subscribe to our channel for more content on personal finance and investing. In our next video, we'll be talking about the No Surprises Act and how it can help you avoid surprise medical bills. We'll also be discussing the best ways to negotiate with medical debt collectors and how to use a credit card to pay off medical debt. It's going to be a really informative video, so be sure to check it out. Thanks for watching, and we'll see you in the next one. Let's consider the power of compound interest and how it can work in your favor when you start investing early. For instance, if you invest $5,000 at the age of 25 and earn an average annual return of 7%, you can expect to have around $38,000 by the time you're 50. However, if you wait until you're 35 to invest the same amount, you'll only have around $23,000 by the time you're 50. That's a difference of $15,000 just by starting 10 years earlier. Another strategy to consider is tax-advantaged investing. By utilizing tax-deferred accounts such as 401k, IRA, or Roth IRA, you can reduce your tax liability and keep more of your hard-earned money. For example, if you contribute $5,000 to a traditional IRA and you're in a 24% tax bracket, you can save around $1,200 in taxes. This can add up over time, and it's a great way to optimize your investment strategy. Diversification is also crucial when it comes to investing in real estate. Instead of putting all your money into a single property, you can consider investing in a real estate investment trust, REIT, or a real estate mutual fund. This way, you can spread your risk and gain exposure to a diversified portfolio of properties. For example, let's say you invest $10,000 in a REIT that focuses on commercial properties. You can earn rental income and potentially benefit from long-term appreciation in property values, all while minimizing your risk. In addition to investing, it's essential to have a solid emergency fund in place. This can help you weather financial storms and avoid going into debt when unexpected expenses arise. A general rule of thumb is to have 3 to 6 months' worth of living expenses set aside in a readily accessible savings account. For instance, if you make $4,000 per month, you should aim to save around $12,000 to $24,000 in an emergency fund. This can provide peace of mind and help you avoid financial stress when unexpected expenses come up. It's also worth considering the benefits of automating your investments. By setting up a systematic investment plan, you can transfer a fixed amount of money from your checking account to your investment account at regular intervals. This can help you avoid emotional decision-making and ensure that you're investing consistently, regardless of market conditions. For example, let's say you set up a monthly transfer of $500 from your checking account to your investment account. This can help you invest a total of $6,000 per year, without having to think about it. Furthermore, it's essential to monitor and adjust your investment portfolio regularly. This can help you ensure that your investments are aligned with your financial goals and risk tolerance. For instance, if you're approaching retirement, you may want to shift your portfolio towards more conservative investments, such as bonds or dividend-paying stocks. On the other hand, if you're just starting out, you may want to invest more aggressively in stocks or other growth-oriented investments. By regularly reviewing and adjusting your portfolio, you can help ensure that you're on track to meeting your financial objectives. Another important aspect of personal finance is estate planning. This can help you ensure that your assets are distributed according to your wishes in the event of your passing. By creating a will, establishing a trust, or setting up a beneficiary designation, you can help minimize taxes and avoid probate. For example, let's say you have a $500,000 retirement account and you want to leave it to your spouse. By designating your spouse as the beneficiary, you can ensure that they receive the funds tax-free and without having to go through probate. In terms of investment returns, it's essential to have realistic expectations. While it's possible to earn high returns in the short term, it's unlikely that you'll be able to sustain those.